The federal funds rate is the interest rate at which depository institutions lend reserve balances to other depository institutions overnight on an uncollateralized basis. In simpler terms, it is the rate at which banks and credit unions lend money to each other to maintain the reserve requirements set by the Federal Reserve. The federal funds rate is one of the most important interest rates in the U.S. economy. It is used as a tool by the Federal Reserve to control the supply of money in the economy and to influence the overall level of interest rates. When the Federal Reserve wants to stimulate the economy, it may lower the federal funds rate to encourage borrowing and spending. Conversely, when the Federal Reserve wants to cool down an overheated economy, it may raise the federal funds rate to discourage borrowing and spending. Changes in the federal funds rate can have a ripple effect throughout the economy. For example, when the Federal Reserve lowers the federal funds rate, it becomes cheaper for banks to borrow money. This in turn leads to lower interest rates on loans for consumers and businesses, which can stimulate economic activity. On the other hand, when the Federal Reserve raises the federal funds rate, it becomes more expensive for banks to borrow money, leading to higher interest rates on loans, which can dampen economic activity. The federal funds rate also has an impact on other interest rates in the economy, such as mortgage rates, car loan rates, and savings account interest rates. When the federal funds rate changes, it can lead to corresponding changes in these other interest rates, affecting the cost of borrowing and saving for consumers. Overall, the federal funds rate plays a crucial role in the U.S. monetary policy and has a significant impact on the overall health and direction of the economy. Its movements are closely monitored by economists, investors, and policymakers as a key indicator of the state of the economy and the future trajectory of interest rates.